When most of us think about the financial markets, we picture this intense battle of wits, right? A fight over information and capital. But what if I told you the real game, the meta game, is being played on a completely different field? Today, we're going to pull back the curtain on the market's unseen hierarchy. And it's a structure defined not by what you know, but by how you see time itself.
Look at this. All this activity, screens flashing, people shouting, it gives you this illusion of control. But really, a lot of it is just noise. According to our source material, underneath all that chaos, a much more basic, fundamental game is being played, and it operates just like a natural ecosystem, complete with a very, very clear food chain. And that's where we get to the real heart of it all. Just for a second, forget the crazy algorithms, the secret tips, the mountains of data. What if your place in this ecosystem, whether you're the hunter or the hunted, is decided simply by your own psychological clock? What if your very definition of the word now is what seals your fate? So let's break down this hidden hierarchy. The big idea here is that the real split between the winners and the losers, it's not about being smarter. It's not about having some secret piece of information. No, it's about something way more elemental. Here's the core concept. You've got different players in the market who are all operating on completely different clocks. I mean, they're in the same place, looking at the same prices, but they are experiencing time in fundamentally different ways. And believe it or not, that single difference in perception is what creates the entire structure of the game. So this split in how people see time, it creates two totally distinct groups of players, each running on its own clock. We've got the liquidity class, and we've got the capital class. And understanding the hidden conflict between these two, well, that's the key to understanding the market itself. Okay, so look at this breakdown. It's night and day. On one side, you have the liquidity class. These guys live and die by the daily cycle. Their whole world, their now, ends at that 4 p.m. closing bell because they're terrified of holding a position overnight. In this ecosystem, they are the biomass. They're the fuel. But then, on the other side, you have the capital class. Their sense of now is almost geological. It's the entire life cycle of a major market trend. For them, holding overnight isn't a risk. It's just the price of admission for capturing a much, much bigger prize. They are the apex predators, and they feed on the predictable, fearful behavior of the biomass. And this quote, wow, it just nails the whole irony of the situation. The liquidity class, they think closing out their positions every single day, being flat, is just smart risk management. It feels safe, right? But that feeling of safety is a total illusion. Their predictable, fear-driven need to get out before the bell is the very thing that makes them a target. It creates a massive advantage just for somebody else. So you start to see that a lot of the common advice you hear, get in and get out quick, never hold overnight, it's basically a kind of theater. It's a performance designed to make the novice feel safe and in control when what it's actually doing is reinforcing the very behaviors that guarantee their capital gets systematically siphoned over to the patient, long-term players. So, if that's the problem, what's the solution? How does the capital class actually operate? Well, it's all structured around something the source calls the alchemist's trading pyramid. And this isn't just some checklist. It's a formula for transforming how you see the world into actual profit. Now get a load of this breakdown. It completely flips conventional thinking right on its head. A massive 80% of the focus is on the why, the deep structural reason a market has to move. Everything else just flows from that. And look what's at the very top, taking up a tiny 1%, psychology. The one thing that most struggling traders obsess over day and night is actually just the tiny little capstone on top, not the foundation. Let's just walk through these steps real quick. It all kicks off with the why. Truly understanding the market's invisible architecture. Where's all the trap liquidity? Where are all the stop-loss orders clustered together? Once you see that, the direction is just a simple deduction. The when is about pinpointing that perfect trigger. The risk, that's your predefined escape hatch, the exact point where you know your why was wrong. And only then, when that entire structure is built, does psychology become the easy part. It's just calmly executing a plan you already made. Okay, so how do we actually do this? How do we start to see the why? Well, it means learning to look at the exact same chart with two completely different minds at the same time. It's kind of like developing a form of analytical schizophrenia. First, you've got the retail lens. This is how pretty much everyone is taught to see a chart. They're looking for the obvious stuff, clear support and resistance lines, standard signals like the RSI. What they're really looking for is clarity and confirmation. They want to be part of the crowd because, hey, there's comfort in numbers. But now you have to overlay the professional lens. A pro looks at that same chart and asks a totally different set of questions. They're thinking, where did the crowd get in? Okay, so where are their stop losses clustered? They see those same obvious patterns not as signals to follow, but as a roadmap to the crowd's predictable behavior. They're actually looking for the ambiguity, the imbalance, because that's where the real opportunity is hiding. So all of this, it leads to a pretty stark conclusion. The market isn't some magical money printing machine. It's a closed system. And in that system, you are faced with a fundamental choice about the role you're going to play. And let's be crystal clear about what a zero-sum game means. It means for every single dollar that someone makes in profit, another person has to lose a dollar, period. It is a direct transfer of capital from one person to another. This is not a collaborative environment. It's a competitive one, a battlefield. So the single question this entire explainer boils down to is this. Are you going to be the liquidity provider, the one whose predictable, fear-driven actions are the fuel that makes the market run? Or are you going to be the liquidity taker, the one who understands this game, who operates on a longer time frame, and who patiently waits to capitalize on that very fear? The path to switching sides, it sounds simple, right? But it's incredibly difficult in practice. You have to consciously expand your time frame way beyond the daily noise. You have to stop chasing price and start hunting for the deep structural why. And maybe most important of all, you have to master the art of strategic patience. You have to learn to wait. And I just want to leave you with this final thought from the source material because it wraps this whole idea up perfectly. In this huge, complex ecosystem of the market, just like out in the wild, victory doesn't always go to the fastest or the strongest. More often than not, it goes to the one with the discipline and the patience to wait for the perfect moment to strike.